Thank you, Fernando. Thanks for inviting us to talk about our work. Crypto assets, like Martin said, has been taking up a lot of time and mental energy in terms of thinking about what the next step should be. If I can just start with a big picture sort of framework, which I think you're hearing from each of us, I just want to sort of maybe put it into my own words, which is I think there's three things that we probably are all trying to do. You've heard a lot about us trying to agree on minimum standards that can be applied globally, and that's a lot of what you've heard is us working on that. And Martin was just alluding to the second one, which is once we have those in place, we have to work to ensure that those are implemented consistently around the world. You can't have pockets where it's not implemented. It just doesn't work at that point. And then the third piece is, I think you heard it a few times already, is this is an area that's just changing rapidly. Martin referred to 3 different phases. Neil referred to some changes and how hard it is to categorize things. We have to have a framework in place that ensures that we're going to cooperate, coordinate, and share information, because once we put these standards in place, we can't just sit back and go, it's done. We have to be talking to each other all the time. So that's the sort of big picture of what we've been working on. That's where the firms are going to go. And we've seen with events already that that's just not a good outcome. And then we have committed to assessing the implementation by the end of 2025, the assessment of the implementation of our recommendations by the end of 2025. So we're going to let people put things in place, and then we're going to take some action. And I'll stop there.
We making moves. We making major moves. We making moves. We making major moves. We going all in like we got nothing to lose. We making moves. We making major moves.
What is up, everybody? I'm Mr. Man. Welcome back to my channel. It's been a minute since I've been in my home studio. It's not even a home studio. I'm just in the basement. But it is my home studio, and I'm happy with it. I was going to talk about stablecoins. I've been chatting with my boy 801 XRP, and he wants me to touch on stablecoins coming from the U.S. side of things, the Stablecoin Clarities Act. And I was chatting with Smoke recently, and we went back and forth about implementations of CBDC and how that'll look, and the year of when that'll be implemented. So yeah, that's what I'm going to touch on today. I'm going to go back to the stablecoins circumstance in another video. But before I get into that, you guys here, this is my roadmap. This is part 2 of the roadmap here, completely filled out. I can't say completely, but this one here has a lot more substance than the other one. And as you saw from that video there, that was the FSB Financial Stability Board, and they're talking about the reevaluation of cryptocurrencies and the adoption that had taken place in 2023 last year, because today is February 20th, 2024. So this was last year. We got a lot coming up in 2025. This is the roadmap here I've created based off of the information that I found so far. Please give this a like. Please give it a share. Please give it a look and check it out. So we started going into stablecoins. We were talking about stablecoins being implemented January 1st, 2025. This is the BCBS, which is the Basel Committee, which states what money is and the risk-weighted amount that needs to be held in a vault or in somewhere else for this stablecoin to have this value, this peg to this issuance. The recently published finalized standard on the prudential treatment of crypto asset exposure, final standards, by the Basel Committee on Banking Supervision, the global final standard setter for the prudential regulation of banks, outlines the future regulatory baseline for banks to address risks from crypto asset, incorporated into the Basel framework as a new chapter, SCO 60. And that is in the prudential treatment of crypto assets. And that's what makes money, money. Or currency, currency. And we had gone through this already. Crypto asset exposure and market for implementation by January 1st, 2025. The final standard has already been picked up as part of the current legislative procedure to amend the capital requirements. And there's one more thing I wanted to go over in here. Right here. Infrastructure risks add-on. Even where banks are meeting the stringent requirements for Group 1 crypto assets, Group 1 crypto assets are pegged to your or tied to your traditional assets, and Group 1B have a stabilization mechanism to them. A holding in crypto assets may become subject to a capital add-on for infrastructure risk compared to holding a traditional asset. The committee does not specify any particular risk to require an add-on, but is concerned that DLT is still new and evolving and may pose various unforeseen risks. Arguably, the proposal thereby is deviated from a technology-neutral approach and adds a risk add-on that is not grounded in the structural arrangement of Group 1 crypto assets, but based on the technology itself. Different from the consultation, and after criticism from the industry, the committee has agreed to replace a fixed 2.5% risk-weighted add-on with a more flexible approach that allows authorities to initiate and increase add-ons. So that's what I want to show you guys. That's the change, okay? That was the change that had come down the pipeline, not to me, but I picked it up, found it, and want to show you guys. So we know that stablecoins come before CBDCs. All right. This is what's her face there, Cecilia Skinsley. I want to show you guys who she is. So this is who she is here, right on the BIS website. Cecilia Skinsley, head of the BIS IH Innovation Hub. Cecilia Skinsley became head of the BIS IH in September 2022. She is a member of the BIS's executive committee. Previously, she held the position of first deputy governor of Sveriges Riksbank, so Riksbank, in 2019. Most recently, she chaired the BIS Committee on Payments and Market Infrastructure, so PFMI, Futures Payment Working Group, as the governor of Riksbank, alternate on the General Council of the ECB, and a member of the Advisory Technical Committee of the European Systemic Risk Board. Holy hell, okay. So that's who she is. There's a lot here on her. I could go deeper, but why bother? You know who she is. She's on the BIS's website. You can go to the BIS's website, pull her name up, and you'll see all this here. But let me get back to where I was going now. So here we are. Listen to what she has to say. Right? We've already come to the conclusion that stablecoins come before CBDCs. Let her explain to you why that is now.
But at the same bit detailed, but I think legislators should sort of walk the talk and say, okay, if cash is important for people, we need to put the right legislation in place. But at the same time, investigate into, okay, if these opportunities are there with the technology, can we actually, be ambitious and see if we can put the system to a new equilibrium? And the first picture I had was not a coincidence. It was a try to illustrate infrastructure. And if you go back in history, often the private sector is first. You can think about that when it comes to canals in the UK and railways. But after a while, the public sector steps in and sort out the foundation so that the private sector can innovate on top of that.
So you heard her what she had said. Private sector often comes in first, and she gave an example, and then public sector comes in afterwards. The coexistence of private sector stablecoins and public sector central bank digital currencies is a topic of significant interest and discussion in the financial sector. Stablecoins are private, stabilized cryptocurrencies pegged to another currency, commodity, or financial infrastructure, aiming to maintain a relatively stable value over time. On the other hand, CBDCs are digital currencies issued by central banks and are state-issued and operated. So we have the concept or idea and notion injected into our thought parallel now that private sector comes before public sector, right? So that's what we've been told. That is what we've been told. We know stablecoins come January 1st, 2025 in terms of legislation or framework now being implemented, and then the different countries can now implement their stablecoin framework. Should they choose. The European Union is doing the reverse. So did the US. They have their stablecoin stuff ready to go already, even though they've done pilots already. But now there's going to be a legal framework, if you will. But I'm building up to something here. I'm building up, I'm building up, I'm building up. So what does that look like? What does adoption look like?
As I project out into the next 5, 10, 20, 30 years, I see technology taking off as a J curve, like a hockey stick. And when it begins to climb steeper and steeper, I do worry the ability of individuals like you and me, as well as societies, to adjust to the changes. Just consider OpenAI, what it may do. Just consider the ethics issues in biotech. So I fear that as the J-curve begins to rise, that the effect of technology, which has been until recently much more good than bad, may turn and have a lot more bad than good.
So why does he state that? I remember buying marijuana stocks when I was in university, and I had bought them pre-regulations, all right? And they were going up. Boom, just going up. As soon as regulation hit, they dropped down. That's not going to happen with cryptocurrency. But if you remember when the internet first came around, the dot-com bubble came around at that point, the internet had taken off at this point, long before regulations had come in place for it. But then regulations came in afterwards. They had finally caught up. And now with the birth to our knowledge, to the mainstream's knowledge of artificial intelligence, because they're playing around with ChatGPT now and all these other new chatbots, it's new to us, not new to them. They've been playing around with this for years, right? This has been going on for years, from back in the 60s. So, when these things take off, they are going to be pre-regulation. They are going to be pre-regulation. We won't have the opportunity to we will not be in a regulated situation at first, because blockchain will take off, artificial intelligence will take off, regulation will be far behind that, and they'll be trying to catch up. So we'll need to figure out, we'll have needed to figure out what we were doing long before this takes place, so that way we can stay ahead of what's going on. This is a curve that we need to be ahead of, all right? So when that goes up, you better make sure you have your plan to implement that plan. I'm going to touch on that again. I will get back to that.
You will also have stablecoins. So stablecoins are not cryptocurrency. It's really asset-backed digital currencies, which essentially is a bridge to CBDCs in the future, right? Not many CBDCs are implemented yet. So what we have built already is the infrastructure. Obviously, stablecoins will be the bridge for that and will come in a much closer future compared to CBDCs. Okay.
So we've also heard that stablecoins are in a much closer future than CBDCs. I don't know why these guys are playing commercials here. They're getting free airtime on my show. I don't know who they think they are. Let's close them out. Okay. So we know this now, right? We've heard things that corroborate what we've been reading, and now let's continue on. And these come directly from the horse's mouth in terms of the legislators as well. So here we are. Mainstream crypto adoption. This is the conversation I was having with my boy Smoke. How and when will it happen? And this is an article from September 12th, 2023. And here, all right? So article summary. Professor Carlotta Perez explains that technology adoption happens in waves that include booms and busts. Approximately every 20 years, there's a change from the early stage to the mass adoption stage. Currently, the cryptocurrency industry is still in the installation stage, with adoption occurring in discrete clusters in different parts of the world. The three main challenges to crypto adoption are lack of education, inconsistent regulations, and very low accessibility or ease of use of crypto-based applications. One of the key things needed to achieve crypto adoption is an app that can attract millions of users, similar to how Google, Amazon, Facebook, and YouTube played a role in the mass adoption of the internet. So I'm going to end up posting this video on YouTube. Also, I'm going to post this video on X. What do you think X is trying to become? One of these super apps in terms of utilizing cryptocurrencies. I don't mean Bitcoin, trading Bitcoin or giving Bitcoin to somebody. I mean in terms of utilizing it and maybe potentially having an exchange. I don't know what it looks like in the future, with X. But believe me, there will be something, and X is going for that super app category or strategy here. So this here comes from my boy Smoke. So here, penetration of target market. There is early adopters, early majority, late majority, and then the laggards. So just looking at this now a bit further, here we are, tokenization adoption curve, the ideal point to enter crypto market, which is where we're in right now. All right, here's the innovators back in whenever that year was. Early adopters, here's the early majority, which is where a lot of people are going to be jumping in now because they're finally catching on to cryptocurrencies. And then the late majority is coming up. We are in that J curve. We heard the individual talk about once that J curve takes off, we are in this J curve. We are right here. And once this thing begins to pick up speed and momentum, you better watch out. And then here's the laggards, the slow people of the world, the ones who will miss out and have no idea. Because when you say the term cryptocurrencies, like some of my friends, a lot of my friends, practically all my friends, when you say the term cryptocurrencies, no, I don't want to hear that. I don't want to hear that. And you ask them, follow-up question, do you know what cryptocurrencies are? Yeah, well, the cryptocurrencies are not good compared to our regular currencies. You obviously don't know what cryptocurrencies are if you're comparing it to a regular currency. But I understand it because that's what the mainstream would have us to believe, especially with the term currency. It's a misnomer. And you would think that they did this on purpose, actually. So crypto adoption, where are we going? And this also came from my guy Smoke. In order to forecast where cryptocurrency adoption is going to develop the future, it makes sense to analyze historic developments in the past. In this regard, several remarks with respect to the historical developments in technical adoption are in order. According to the model first introduced by Rogers in 1962, technical adoption usually follows a pattern with 5 distinct groups of adopters. You have the innovators, which we just seen. Go back and show you guys. There you go. We have the early adopters, the early majority, the late majority, and then the laggards. Based on this model, in most countries today, we are still in the early stages of crypto adoption with only innovators and early adopters, which is 16% of the total population, using cryptocurrencies according to most retail surveys. This is particularly true for developed countries. I know you and me are in this. We're in it to win, right? We're not using Bitcoin as a currency, right? We're not using that. They call it a store of value now for a reason, because it's not a currency. It fluctuates too wild. Technological adoption usually follows an S curve, right? Down and then up, which represents a logistical growth function. The exponential growth of a small population creates the lower curve of the S. As the population gets close to its carrying capacity and its growth rate increases, the upper curve of the S is produced. ICI and ICI Global welcome EU consideration of T+1 settlement cycles. So for CBDCs to be adopted, we cannot settle in T+1 settlement times. That's, you purchase a stock and then it finally settles the day after. That's T+1. T+0 is instant settlement. That's what we need for CBDCs to settle. Today, this is December 15th, 2023. Today, the head of the ICI Global released the following statement on the European Securities Market Authorities, which is ESMA, call for evidence on shortening the settlement cycle. Now we're going to stick with this whole topic here, okay? ICI and ICI Global support European Union authorities shortening the settlement cycle from T+2 to T1. This will incentivize market participants to modernize their processes through greater use of technology, automation, and standardization. The end result will be increased efficiency and cost effectiveness and will better serve investors. We call on EU authorities to decide in early 2024 to commit to moving to T+1 settlement and to communicate a clear 24 to 30 month path to implementation so that policymakers, stakeholders, and market participants can get started. Acting expeditiously will help minimize the duration of misalignment with the North American markets. EU regulators should coordinate with other jurisdictions and establish dedicated dialogues with the UK and Switzerland to facilitate a globally aligned move to T+1. We urge the EU not to pursue moving to T+0 settlement at this time, as this represents a substantially more complex undertaking than moving to T+1, would misalign settlement cycles worldwide, and would reduce the efficiency of EU capital markets. We remain committed to supporting the transition to T+1 settlement across EU capital markets, building on our experience in leading industry efforts to prepare to the move to T+1 in North American markets. So here we are on central banking website. The EU considers shift to T+1 or T+0. It looks like an O. The European Union is considering moving towards the instant settlement of securities transactions amid the global shift towards tokenization. The ECB board member Piero Cipollone said on February 9th, that's just a few days ago. In this announcement of such a move, Cipollone said in a speech that the ECB was considering a shift from T+2 to T+1 or even T+0 to avoid mismatches in settlement cycles and keep European markets attractive. This would mean securities transactions being settled one. Being settled one. Oh, okay, that doesn't make sense. Being settled one. We were talking about ISMA. This is that documents are talking about now. The call for evidence here. This is one that came out October 5th, 2023, and ended period December 15th, 2023. There it is right there, December 15th. So ISMA invites comments on all matters of this paper, and in particular on the specific questions summarized in Annex 1. Comments are most helpful if they respond to the questions stated, indicate the specific questions, contain a clear rationale, describe any alternatives. Okay? There is no legal or regulatory impediment in the EU to operate settlement cycles shorter than T+2 yet. However, regulatory intervention can be necessary to achieve this objective in a harmonized way. Given that it could be difficult for a single operator to implement the change if all others do not follow. So, what it's saying there, what it's suggesting for this evidence here, if we move to T+1, who else will be ready? Will anybody else be ready? Will other people be ready? Because we have to do it in a harmonized way. If we are going to use CBDCs, being the EU, everybody's got to use CBDCs, right? Because like, it's like for the US to move to T+0 and move CBDCs, the globe must be ready to use CBDCs because more than half of the world is still on the US dollar as it stands. At the same time, a decision to shorten the securities settlement cycle in the EU needs to be based on a proper assessment of the costs and benefits that such a change would bring to all users of financial markets in the EU. The objective of this call for evidence is to complement the information at ISMA's disposal in order to produce such an assessment. Okay, so what we're going to do now is go to ISMA's site. So here we are. Here's the call for evidence on the shortening settlement of cycles. And here, as we go down, here are those documents that we were just reading, or the documents we were just reading. And here are the institutions that had replied to those questions. So we read 9 and 10, and that's what we're going to read, 9 and 10. So let's see who's all here. All right. BRD Group, Nordic Growth, Austrian, CLS Bank, Czech Bank, German, Czech Capital. Where are we at? Swift. Swift is one of the big names. Let's see what Swift has to say about this. So we got the Swift document opened up here. Let's go down and see what they're going to say. Do you agree with the mentioned benefits? Are there other benefits that could be accounted for in this assessment of an individual shortening of the settlement cycles? Oh, they didn't write anything here. Type your text here. Nothing there, nothing there, nothing there. Here's what they typed. Okay, so let's go through some of these questions they have here. In your view, by how much would settlements fall increase if T+1 would be required in the short, medium, and long term? What about T+0? Please provide estimates where possible. In the event of transitioning to a T+1 settlement cycle, there is the likelihood that settlements fails may increase, particularly in the short term. The extent of this increase is contingent upon the ability of market participants to adopt the accelerated timeline. Some firms lack the necessary resources to process settlements in shortened timeframes, while others rely on manual processes. Still, for these firms, the move to T+1 could lead to an increase in the late settlements rate. According to the data from the SWIFT network, within the current T+2 framework, 5 out of every 100 securities transactions sent for settlement already fail to complete on their expected date. This is costing the industry billions. So if they were to jump and go to T+1 or T+2 immediately, not following the timeline, that could be detrimental. In the medium and long term, though, the increase in settlement fails could be expected to decrease as market participants adapt and implement new solutions and processes to accommodate the shorter settlement cycles. The extent of this decrease would depend on the pace at which industry-wide changes are adopted and the effectiveness of these solutions. While the increase in settlement fails may not be permanent, it serves as a warning about the critical role of preparation in ensuring a smooth transition and minimizing disruptions. With adequate preparation, settlement efficiencies can recover over time as market participants adapt to the new settlement cycles and implement solutions to mitigate challenges. Thank you, Swift. Thank you. Appreciate that. Who else is here? UK Finance World Federation. Febelfin. Sorry, I couldn't help myself. German Finance. I'm 41, man. My birthday was like what? This is the 20th. My birthday was 5 days, and 5 days ago, and I still act like a damn juvenile. A mature juvenile, but I know how to have fun. The DTCC. What do you say? What do you got to say? Boom. Let's check it out. Let's see what the DTC has to say. Oh, that's a long. Look at the length of these. 6, 7, 8. Did you answer it? You answered 9. You answered 9. This is my first time seeing this too. I just pulled these up so I could read them to you guys. So this is all new information to me. Do you agree with the mentioned benefits? Are there other benefits that could be accounted for in the assessment of an eventual shortening of the security settlement cycle? Yes, we agree with the benefits mentioned by ISMA. For T+1, have been well documented. While we acknowledge the differences between the EU and the US North American markets, our experience in the US has shown that the linear evolution of shortening the settlement cycles have brought about significant benefits. In the US, the primary motivation for accelerating the settlement cycles is to reduce the overall level of systemic risk in the financial system. The length of the settlement cycle is important because there's a risk that a trade counterparty may not be able to fulfill its obligations between the time of a trade is executed and settlement. The longer this period of time, the greater the risk. It's interesting. So they're saying the complete opposite to what Swift is saying. The risk becomes elevated during times of high volatility and stressed market conditions, as unpredictable market events such as the risk of a firm defaulting can potentially impact the transfer of cash or ownership of securities, which we've lived through. Silicon Valley Bank and a few other banks that have failed last year as well. Accelerating the settlement cycle would significantly increase market efficiency and mitigate market and counterparty risk, particularly during times of extreme volatility. There are several dimensions to this. As longer settlement cycles equate to increased risk, market participants face higher margin requirements with a 2-day settlement, that's T+2, to manage those risks. A shorter settlement time frame would reduce market requirements and therefore free up capital from market participants. They got a lot to say. For investors to move to T+1 would also make cash and securities available sooner, leading to an overall optimization of the use of assets. Accelerating the settlement cycle to T+1 would also be a catalyst for market participants to migrate to more efficient ways of securities transactions processing, including further automation and the adoption of industry standards. The systems and process improvements required to move to T+1 would thus be expected to reduce operational risk and further enhance market resilience and efficiencies. So from what I'm hearing here, the DTCC is suggesting that they're ready to move to T+1. They are ready. They want to reduce risk. Swift is like, hold on, let's put some brakes on here. You guys trying to take a piece of my corner here. I own this block, and we settle in T+2, son. I don't know who y'all think you are, but y'all don't recognize I'm Swift. If we change too fast, it's going to cause chaos here. The DTC is like, yo, brethren, we got this. What do you mean? What do you mean you're living back in the 70s still? Swift is like, yo, son, I was born in the 70s. I do what I know. If it ain't broke, don't fix it. DTCC is like, son, you broke. We fixing you. That's what's going on here. There would be an additional benefit of aligning settlement cycles with other non-EU jurisdictions. See question 23. Do we want to read number 10? Please quantify the expected savings from an eventual reduction of collateral requirements derived from T+1 and T+0. What do you guys think? Should we read this? It's been about 30 minutes already. Should we read this? Yeah? All right, let's do it. Let's do it. As per our previous response, we will only focus on the T+1 case. So they're not ready to move to T+0 yet. They're not talking about T+0. They're not talking about the implementation of CBDCs yet. We're moving to a T+1 with stablecoins, which is private money first. It's a slow adoption, which is private money. We got VCs, venture capitalists using stablecoins, right? Private money. It's faster than what we have now, but a lot slower than when the public money floods those public markets. It's expected to reduce the NSCC's daily clearing fund requirements on average by approximately 31%. That's massive. We also expect a further reduction in risk and margin requirements related to bilaterally settled trades, even though these savings have not been quantified given the bilateral nature of these transactions. While the data may differ from the EU markets, we believe that for specific asset classes, the margin savings would be similar nature. For instance, in the US, cash securities transactions between institutional clients and broker dealers can be netted and cleared through a CCP, not the Communist Chinese parties, which reduces settlement risk and costs. This workflow is prominent where a prime broker acts as the settlement agent for an institutional buy-side firm. There's the buy-side firm and the sell-side of a firm too. There's typically two sides. Prime brokers are commonly used across EU markets and could play a pivotal role in increasing clearing and thereby lead to settlement efficiencies. We are happy to work with the EU CCPs to offer a more consolidated output on the collateral savings on a T+1 environment. Just jumping back to Mr. Man timeline to a crypto adoption here, the roadmap. Here we have 2024. We have Canada and US at the very top there. T+1, May 28th, 2024. So we know when that change is happening now. We're still ahead of the curve. All right, I'm telling you, download this because all these here are clickable. I have them in my Google Drive, and all these links are clickable. They are links to something, so it'll give you the actual evidence. It's not me just saying things and writing things down. I'm putting down the actual fact, pen to paper, and providing the receipts for what's going on in the world, son. Who else is in there? Who else? All right. Let's just go down the list there. The Alternative Investment Management, Luxembourg Bank, Finance Finland, the ICMA, ISLA, okay. So we got some big names here responding. We got Six Group. We all know who Six Group is. You should know. You should know who Six Group is. We got SIBO here, Chicago. All right. Who else is here? A lot of names I'm not familiar with too. PGGM, BVI, Association of Finance Denmark, Euronext. I know Euronext. Association of Global Custodians, State Street, France Post, European Association of CPP, the Clearinghouse. We got Citibank, we got Societe Generale, BNY Mellon. So we got a host of people replying to ISMA there in regards to the transition of a quicker settlement of T+1. We know T+1 is coming May 28th, 2024. Still no word on early adoption yet for CBDCs. My man Smoke believes that CBDCs could be coming sooner, and that could be the case. From where I stand and what I read, I don't know when CBDCs is coming. When I hear these individuals talk, they talk about CBDCs coming out later on in the future. We learned about the S-curve. We've heard about the S-curve. We've gone through the up. This could be the stable coin. And then boom, we hit this second pandemic for all we know. At this point now, this other virus of sorts, the boogeyman, the global war takes place. CBDC adoption, boom! That's a shoot off right there with public money. I could be wrong. I'm just playing this out, right? This makes logical sense to me. Smoke could be right in terms of them coming and doing an early adoption with CBDCs. I don't know. That could be right. I'm just reading the documents and trying to follow the breadcrumb that these individuals here post. What I do know is that adoption takes place January 1st, 2025. We have also EU has their stablecoin regulations being opted into June 2024, and then MiCA rolls in December 30th, 2024, and then boom, stablecoins, they're ready to go. USDC ready to go. Circle with the EURC in the UK, ready to go. Ready to go, ready to go, ready to go. Right? If you feel me, do you feel me? So that's what I got for you today. I hope this wasn't too long. I tried to keep it short. I actually wanted to do like a 10-minute video. I don't know how the hell I would have fit a 10-minute video into all this information, but I hope you guys found some value in this. I'll catch you on the next one.
We making moves. We making major moves. We making moves.